Welcome back to our intermediate financial accounting class. This is another section of our special lecture on intangible assets. Now this lecture is a little bit different from the others we've done. There's no journal entries, no tables, no big financial calculations. Instead, we're just trying to introduce a few key concepts about intangible assets, this last section of our balance sheet. Now in our last segment, we talked about what an intangible is, why it's important, indefinite versus limited life, and a couple of examples of what classifies or qualifies, I should say, as an intangible asset. What we've neglected to mention, or I neglected to mention, is the fact that even though we depreciate most of these assets, we only use one method for amortization, and that is straight line. Now you can use the others, it's allowed, it's just that nobody does. Everybody uses straight line, and usually without any salvage value. I mean, usually we are going to use these limited life intangibles until they're gone. So you just take whatever you paid for them or whatever little bit you could capitalize of your own costs, divide by the time you think you can use it, and that's your amortization expense. Now, at the end of the last segment, we talked then about two upcoming topics that we're going to mention. One very contentious and one that's really changed the face of intangible assets and of the business world as a whole. So we're going to jump right into the first of those, and that is software. Now software became a very contentious issue because software companies were angry about the whole R&D expense thing. Now if you remember, we talked about this last time, we can't start capitalizing the cost of an intangible asset until we're 100% or virtually 100% sure that it's going to pan out and become an asset. Well, software companies were getting bogged down with this particular requirement because by the time they proved it to FASB and the auditors, there was nothing left. And most of these companies do nothing but software development. So they had no assets to show for all of their work. And they were really upset that FASB was insisting on this really long lead time of deciding whether or not this was really going to sell and be a viable asset. The part they were objecting to was that they were insisting that they show they could actually sell it and make a profit with it. Well, not necessarily a profit, but at least make revenues with this software that they were developing. So there was a big fight about it. And finally, the computer companies won and FASB backed off. And so instead of having to wait until you're 100% sure this is going to be market viable, you just have to show that it's technologically feasible. And once you've proven that it is technologically feasible, we can generate the product. Whether or not other people will buy it, that's a different question. You can start capitalizing costs. Now this doesn't let them jump it forward to like the very beginning. You have to show that the code is basically sound, and yes, we're going to be able to do this, but it does allow you to capitalize a lot of the final development costs, a lot of the testing costs, etc. as you work out the bugs, because you've already shown I can make this work. It may take me a while, but I can make it work. And so it satisfied some of this contention. So as opposed to a lot of intangibles, software can actually be capitalized quite early, and quite a bit, not all, but perhaps half-ish of the costs that are put into it. Depends on the company and what they're trying to develop, but quite a bit of the cost can actually be capitalized. Now they do still have a limited life. Most companies use straight-line amortization just like we do for most of the other intangible assets, but there is a second option that is used quite commonly here, and that is to use a ratio. So what we do is we estimate all the revenue we think we're going to make with this software. We put that down in the denominator. And for our numerator for this period, we use just the current revenues that we actually made. And that gives you a percentage, and you take your depreciation base or your amortization base, and you multiply that by the percentage, and that's what you amortize away. Again, other options are allowed, but usually we see straight line, except in software where we'll sometimes see this other option as well. The next intangible that we want to talk about specifically is goodwill. And goodwill has had a huge impact on the business world. There is so much involved with goodwill. You see, goodwill is the difference between what we pay for a company and what it's worth on its books. Remember that we keep track on our financial statements, specifically in the balance sheet, of all the assets of the firm, the liabilities and the claim of those debt holders on those assets, and then the balance belongs to the owners. So from a financial accounting perspective, what you pay for a company should be that equity amount that's on our financial statements. That's what you're buying. But it's very rare that companies pay exactly what that equity amount is. They usually pay quite a bit more. Why? Because they're buying all of these intangible assets. not specifically buying copyrights and patents or customer lists, but we're getting all of that. We're getting the value of their copyright. We're getting the value of their trade name. We're getting the value of their reputation by buying out this company. It's the one time where we really get the full value of the intangible assets of a company. And we get to call them all goodwill, just this big lump intangible asset that encompasses all of what you're buying that's not a physical asset. We can only record this when we as a company have purchased a subsidiary. You can't do this with your own company. Hey, we think our golden arches are worth this much. You can't estimate it. This is only done when you purchased another company, because that's the only time we're 100% sure what that extra value is. I can take what you actually paid minus what the company shows as net assets and see what the value is of the synergies and the customer base and the knowledge of the employees, etc. I can see what all of that is worth because it's finally been purchased. And you can imagine if I were to try to buy something like Apple or McDonald's and trying to pay enough to cover the cost of this company's brand image, it would be a huge amount. So it's big business, shows up on a lot of books. It's become kind of a pain to impair and keep track of. It has become a major issue within the financial markets. And it changed the way that companies do some of their purchases, because now we can keep track of what it's worth on our books. It just doesn't all go away when I pay this extra money for a company. So that's the reason that this has become such a big deal in the markets, is because of the way that this allows us to show the true value of a company on our books. The other reason that it's been a big deal is because there was a fight about goodwill. It was contentious because for a long time you had to amortize away your goodwill over a specific period of time. And exactly how long depended on the company and the era you were in and what set of rules there were. But we amortized it away as a limited life asset. And companies didn't like that. And their argument to FASB was, you know, we bought this subsidiary for all of that goodwill, all of these intangible assets that they own. We're going to keep that up. That's why we bought it. So it shouldn't just be amortized away. We're going to maintain that. I mean, unless we're buying McDonald's and then changing its logo, those golden arches are going to be kept up by us. Why would we amortize it away and get rid of it? And FASB finally acquiesced to that logic and said, okay, you're right. We're going to treat it like it's a limited life, or excuse me, an indefinite life asset, because you're going to maintain the value. But you still have to do a test to make sure it's still retaining the value that you thought it had originally. And we'll talk about those tests in just a minute. But there was a big fight about this, and in this case, companies won. Now, there is a special case of goodwill, and we don't see it very often, but sometimes companies get a deal when they buy a subsidiary. You've got a company that's just dysfunctional, it's not making any money, it's been losing money for a long time, and whoever owns it right now just wants to get rid of it. And so we rush in and buy it, and we get it cheap. And it turns out that not only did we not pay any goodwill for this broken company, we didn't even pay the value of its net assets because the owner was so desperate to get rid of it. We call this negative goodwill. We actually paid less than the net assets. And the way we record this, we don't record a negative goodwill and have this big contra asset on our books. Instead, we get to show a special gain that occurs only in this situation. Again, not a very common thing, but it does happen. The next thing that we need to talk about with intangibles is what we call impairment testing. And if you've already gone through the lecture on property, plant, and equipment, you've already seen a lot of this discussion, so we'll keep it brief here. For those of you who haven't, an impairment test basically means that we think, for some reason, our asset has lost value. We bought this intangible asset, you know, a competitor came out and they produced something even better, or at least on par with ours. We don't think our asset is worth what it was originally because of the competition or because something has eclipsed it. Because we have reason to believe that it's dropped in value, we do an impairment test. And the impairment test, kind of a weird structure. This was another fight. There's been a lot of fights about intangibles. This was another fight between FASB and the companies. And companies fought against impairments tooth and nail. They did not want to have to record it. We'll record the loss when we sell it. We shouldn't have to do it before then. And FASB insisted there are times when you have lost value in these assets, and you need to show that these assets have gone down in value. So they came to a unique compromise, and here's the compromise. In order to do the test, companies will assess all the future cash flows they think they'll get from this intangible asset. They won't discount them for time value. They'll get a raw amount. they'll compare that with the book value of these intangible assets. Book value, remember, is historical cost minus accumulated depreciation. So we compare these raw, undiscounted future cash flows with book value, and if the book value is higher, then we've got a problem. Because it means we think we're going to get all this cash in the future, but we show the asset as being worth even more than all these cash flows. So if that's the case, if book value is higher than the cash flows, then we have to do an impairment. Now that was companies' win, was to say, let's not use present value cash flows, let's use actual cash flows. And companies won that one. Why? Because if I discount cash flows, it drops the value, which means I get a lower number. Time value, present value is lower than actual value. And it became more likely that we'd have to record some kind of an impairment loss. So companies argued about it, and they said, well, let's use undiscounted cash flows, and it reduces the chances that we'll have to do an impairment. That was companies' win. FASB's win was the flip side. They said, fine, we'll let you do the test your way, but if you show, even with undiscounted cash flows, that it's below the carrying value of the asset, the book value of the asset, then you have to write down not just to the undiscounted raw cash flows, but present value of those cash flows. And that was FASB's win. So you do the test. If you show there needs to be a write-down, it's not just going to be a little write-down to undiscounted cash flows. It's going to be a huge write-down all the way down to present value of future cash flows. Looking at it, if you're like me, you just wonder what they were thinking, but that was why they came up with this particular two-part rule, is because that was what we had to do to compromise. We also do impairment testing on unlimited life assets, which means we think they'll never go down in value. And FASB said, look, if we're not going to make you do any amortization or depreciation, then you must do this test with present value of your future cash flows. And again, it was a compromise. We don't have to amortize most of the time, but when we do the impairment, okay, we'll accept that because you're letting us not amortize away anything else. So in this case, it's a really simple test. We get our cash flow estimates for all future cash flows. We do a present value calculation. We compare that with what it's worth on our books. And if the value's dropped, we do an impairment. If not, then we don't have to worry about it. This loss, by the way, really easy to record for both types of impairments. It's just a debit to our impairment loss and a credit to accumulated amortization in this case, as opposed to accumulated depreciation. Let's take just a second and talk about this under IFRS. IFRS also requires impairment testing, but they don't require it occasionally or when you think there's a reason, like US GAAP does. Instead, they insist that you do the test on a regular basis. And if it's an indefinite life intangible, then you have to do the test every single year, because IASB is not as forgiving as FASB is, and they're less likely to believe that, yeah, that intangible asset has kept its value. IFRS also uses just a one-step test. We don't do this undiscounted and then we write it down to discounted. No, we compute this recoverable amount, and then we compare that to the carrying value, and if we need to, we write down the value to the recoverable amount. The recoverable amount is the greater of either the present value of future cash flows or what we could sell the asset for. So if I think I could sell this intangible asset to you for $1 million, less about $100,000 in legal fees, then that would be $900,000 would be my recoverable amount, unless I think that my net present value of my future cash flows is $950,000, and then I'd use the $950, because it's whatever is bigger of those two amounts. Now, one of the major differences between US GAAP and IFRS is the fact that under IFRS, you can write an asset back up. So if I go through and I impair this intangible asset, I think it's worth very little now. There's this new medicine that's come out, and the medicine that you were producing just can't compete, so I impair it, it drops drastically. And then the next year, the FDA declares this new drug off limits, and all of a sudden, the value of my drug becomes, I shouldn't just call them drugs, we'll call them medicines. We don't want to encourage anybody to develop drugs. We'll develop medicines. So the value of my medicine all of a sudden jumps back up again. Now under US GAAP, tough. You've written it down, it stays down. Under IFRS, oh yeah, we can write it back up because we allow that kind of flexibility. Remember, IFRS is more concerned with neutrality than conservatism, and it allows us to do those kinds of write-ups and write-downs. So that's another neat option under IFRS, is that if we have to, we can write an item back up. The last thing we need to talk about is how we present intangible assets. And there's not a lot of detail here, but since we haven't done journal entries, I figure we need to go through and talk about at least some of the details. First, intangible assets are usually broken out on the balance sheet. We don't keep them in with PP&E or long-term investments. They get their own section unless there's such a small portion that it's immaterial, and then they can be lumped in somewhere else. The one rule about how we show intangible assets under US GAAP is that goodwill has to be reported separately from all the other intangibles. On the income statement, usually we figure out the amortization on all of our different intangibles and we add them all up and show one amortization expense line item. That's it. Often some companies will even go further than that and they'll just have one amortization and depreciation expense, and now I can't even differentiate between what's amortization and what's depreciation because they've lumped it all together in one big line. The only requirement, again, comes down to goodwill. If you do a goodwill impairment, that has to be reported separately. Finally, let's talk about the notes to the financial statements. Most long-term assets require a few additional disclosures. Most debt requires some additional disclosures. Most of our accounting methods require that we describe them. And there are some of these descriptions and specific rules that we have to have for intangible assets. So first off, R&D expense and what's involved in that R&D expense, research and development, have to be explained. What exactly are you trying to develop? Within reason, we don't want to give away any trade secrets, but we'd explain we're working on a couple of medicines that we're trying to get cleared, or some chemical pesticides that we're trying to develop that are safer for the environment. And that's all the detail you have to give, but you have to explain what all this research and development is for, and you'll usually disclose a little bit about whether or not you think you're getting close to being able to start capitalizing. So we might even see a note, or in the management letter, we've developed this new technology, we're in the middle of testing now, we hope to get it approved and the patent finished in the next 2 years, and you should see us start capitalizing sometime in these next 2 sets of financial statements. The other thing that we have to include in our footnotes are the impairment tests. What assets were we worried about? Why did we have to do an impairment? What did we do, and how did we check, and how did it work out? We include that as well as some details about our amortization calculations from year to year. Now, this wasn't as exciting, I know, as all of our journal entries and tables and financial statements, etc. But these really are important assets, and we need to at least be comfortable with the concepts behind intangibles, and especially that key idea that I can't record intangibles for what I really paid for them unless I bought them from somebody else. If I develop them myself, I only get to capitalize when I'm sure this is going to pan out and be an asset I can really use. And so that amount, instead of being $10 million for that new wonder medicine, that I'm going to develop to cure cancer, I only get to record as an asset the last couple $100,000. And that's it. And understanding that intangibles are worth much more than we really show, is perhaps the most important takeaway from this particular lecture. And with that, we're going to let you move on back into our normal set of lectures, and I'll see you then.